Great way to kick off the day. So I'll hand you straight over to our moderator, Maikie Currie.
Thank you, and thank you everyone for joining us today. The lights are really bright, so if I'm blinking a lot, that's why. The first thing I want to say is congratulations on coming to this session instead of the one on AI. You're already winning. We've got some great speakers today, and we're going to talk about probably one of the biggest challenges and opportunities that sit at the heart of the UK investment landscape, and that is the persistent lack of UK retail investor participation in the markets. Now, we know that the UK, compared to countries like the US and the Nordics, lacks massively, and a lot of that has to do with in terms of the two talks we had, from the introduction from Lord Lee and the brilliant session from Simon French on the myths around the UK economy, is very much around regulation. We have wrapped the UK personal private investor in cotton wool with well-intended but actually limiting regulation. And as a result, we have really managed risk out of the equation, and with that, reward. So I've got three brilliant speakers who I'm delighted to speak to today. We've got Will from the London Stock Exchange, and we're going to talk about the role of the stock exchange, really, some of the influences, some of the campaigns that are coming along, and how we're going to really reignite a culture of private investing. We've got James Deal of Retail Book, who's doing a lot of work in terms of bringing IPOs, and I'm going to push James on giving us a hint, because I know a lot of the retail investors out there in the audience want to know what is in the pipeline. So without breaking any rules, we're going to talk about the interesting and really exciting pipeline of opportunities coming to the UK market finally, after what has felt like a drought. And of course, Lord Lee, who doesn't need any introduction. So I guess before we talk about the rise of retail, we've really got to dig into why the UK doesn't have that culture of investing. And I'll start with you, Will, and move my way across the panel.
I think it was discussed before, but ultimately risk in the UK is seen as perhaps kind of a bad thing. And, standing alone, risk can seem that way, but actually without risk, there often is no reward. So I think in the UK, it's skewed towards protecting the end retail investor so much that in fact, you've managed risk out of the equation. And we talk about this a lot at the exchange. Actually, we're a UK exchange. We want companies to list and stay in the UK, and we want retail investors to want to participate and invest for a very long time. Ultimately, because the US, as you mentioned, or the Nordics are slightly different, it's more attractive immediately for a short-term gain. So whilst we talk a lot about the existing landscape for investors, actually we're focused a lot on the next gen. So those kind of, perhaps sub 30 individuals that want to trade and invest, they're consuming content in a different way. They're getting immediacy, and they want execution straight away, and they want performance straight away, which obviously if you invest for the long term, you're not going to ultimately get that immediate performance. So I think it is the risk profile, and I think we need to kind of reframe that, and that's part of the regulation piece. It's part of us as the industry coming together and providing that, I guess, advice, education, but also it's seeing risk as not a bad thing, but actually, of course, within comparative, it can be a good thing. So I think it's reframing that and re-educating and looking at the next generation to say, actually, we want you to stay in the UK and invest in the UK. It's that risk profile.
So a lot of that is a function of regulation that came in post-financial crisis, but we also know that the retail investor historically hasn't been treated very well in the UK, hasn't got access to those listings. James, talk a bit about what's changing and why that is really a positive change.
So extending what Will's just touched on, it's very interesting to address that today we are seeing the regulatory landscape shift quite dramatically in favour of including the individual, the employee, the customer, and of course the general public, which for the last few decades has not been the case. It's that point you made of wrapping the individual in cotton wool because they can't make their own decisions. And so really exciting that actually the FCA has woken up to the fact that with the availability of information, electronically in whatever form you would like, it's interesting. There's an amazing cohort of individuals that are very well informed, can make the right decision, with full education and input in terms of information, and that sets the landscape. What's also changing, of course, is if a company is going public, historically you would have to run the public offer for a minimum of 6 days, which doesn't sound like a long time. But when the banks turn around to the company and say, don't worry, we'll raise you the money in 3 days, which means you're not exposed to the US market over a weekend and other factors, that's a good reason not to include a public offer. That is changing. It's already been decreed, which is very good news. So we fully expect to see a pipeline of transactions coming through with full public inclusion, which sets us on a new path, and I think turns from where we are right now at a sort of very low point in a long cycle.
But we also know that if we don't open to retail investors, a lot of the investment is concentrated with institutional investors, and that concentrates risk. So to have a healthy capital market, you need retail participation. Lord Lee, some thoughts from you on how we get that participation, because obviously if it's not culturally ingrained, that's not going to change overnight just because regulation is loosening.
Well, I think in my opening remarks, I touched on 2 or 3 of the barriers. Regulation, I talked about the lack of financial education. So those are certainly 2 things that I mentioned. Obviously, I focused on television, for example. I don't know whether people agreed with me on that, or indeed have ever thought about the fact that television doesn't cover the stock market. And television, of course, has been the dominant media until very recently for those actually who have money to invest. Obviously, I mean, excluding young people now and the crypto world, that's a separate problem. But I think there's a big lost opportunity. And just going a little broader, I remember a couple of years ago clashing quite violently with Archie Norman, the M&S chief, at I think it was a QCA conference, when I think it was about 2 years ago, he tried to bring in, or the M&S board tried to bring in a digital-only AGM, which I was violently opposed to. The idea of excluding shareholders from the opportunity of talking and meeting with the board, I thought was totally wrong, and I'm glad to say that they backed off. And now I think it's accepted that ideally AGM should be hybrid. But Archie Norman was saying, and in all fairness, the M&S performance in recent years has been good, so I'm not criticising that aspect. But he was talking about wanting to engage with shareholders. And I said to him, look, if you really want to engage with shareholders, first of all, you as a board need to have regional meetings with groups of shareholders. And secondly, what about bringing in a Marks & Spencer shareholder card, giving you, say 1% off all purchases at M&S? There'd be a massive uptake for something like that. And similarly, so many companies could do so much more in terms of building bridges with shareholders. So I think many of the public companies themselves have got quite a lot to answer for, because they spend a huge amount of time and resource on marketing their products and services to companies, but I don't think they spend much time actually focusing on building bridges with their shareholder base and increasing that shareholder base.
So that is an interesting point, because we have seen some companies, very select companies like Carnival, do activities where they engage with their shareholders, but we know that the next generation of investors, their consumption of media is changing, and we know that financial influencers are playing a much bigger role. Most of us don't consume television in the linear fashion anymore. So, well, I'm really interested in how will we engage the next generation of investors. We have a very small concentrated pool of hobbyist investors, but we want that wealth to trickle down to the next generation. We want young people to start investing. Where does the answer lie between companies doing their bit, as in engaging shareholders and making it more exciting, but also what media and mediums should we be using?
Yeah, it's definitely a changing world. I mean, Lord Lee's point on television is so right, because actually the majority of people that we want to talk to who are retail investors will consume television, or they'll consume streaming content.
But will they consume linear television?
No, they'll probably do some, yeah, exactly. They'll be online doing some other medium. So things like TikTok, which I personally don't use or very successfully, but a lot of people do, and actually next-gen investors will consume their content through TikTok, which is 3-4 second sound bites. And then that decision is made there and then, and they'll go and act on it. So things like finfluencers are obviously on the rise, and they're a great way to get your message out as a company. But obviously the risk is there as well, because there's lots of cowboys and there's lots of things like the FinProm rules with the FCA that you've got to be aware of. But ultimately, I think it's talking to that next-gen investor. So whatever medium it is, it needs to be other than LinkedIn, where we can talk to each other, which, the exchange has been guilty of before, where we'll just say, oh, invest in this or whatever, this is a great company. But we're talking to our own kind of, we're talking ourselves up when actually we need to speak to the retail consumer. So I think finfluencers, TikTok, that changing social media is not going to go away. We've got to get comfortable with it and work out how we can use it to our advantage as an industry.
I think the other point is, and Simon touched on this in his presentation, we have been obsessed, and we are obsessed with home ownership in the UK, and everything is done to encourage home ownership relative to investing in the stock market. If you say in the Sunday papers turn to that frequent page on the back where they're interviewing a certain personality, and they say, when did you feel rich, or do you earn more than your parents, or where was your last holiday? And these are a range of personalities who are covered. They then say, do you invest in the stock market? No, far too risky. Know nothing about it. What's the best investment you ever made? Oh, the flat I bought in Fulham in 1976, as it were. And so, there is this focus, this excessive focus on domestic property, I think, to the exclusion of rather more risk-taking in the stock market and similar.
I guess that brings me back to the topic of intergenerational wealth, because if you think, and I think, Will, we spoke about this before, if someone's child would come to them and said, can you lend me £10,000 to save towards my first property, and parents say, that sounds sensible. If they came to you and asked for £10,000 to invest in a tracker, would we culturally have the same response? Probably not. It's not ingrained. How do we change that, James?
Picking up on this point around the changing face of media, I think we're at a very exciting time, because we've still got newspapers and we still have the television, and we also have so many fantastic new channels for pushing, information, media, and so on. What we're missing right now is a reason to celebrate any success, because there haven't been any IPOs and the markets have been fairly dysfunctional for quite a long time. You see often now in the press talk of us being at a 30-year or 31-year low in terms of activity, and I think that's true. So if what we see is coming to bear, and that is a pipeline of businesses that recognize London as the financial centre that it always was and will be listing here, if dare I say, share prices move in the right direction, there's going to be quite a lot to celebrate. And at that point, I think it's quite interesting that your finfluencer, your social media channels, as well as the broadsheets and the television, are going to be facing the same direction. Now, that's important because, to Lord Lee's point about the homeowner, if suddenly you've opened a Hargreaves Lansdown account or interactive investor because you've participated in investing in a company you recognize, that leaves you then thinking, God, that was easy. I now have an investment account. What else can I buy? And I see Annabelle in the auditorium here. Investment trusts are a very special product. I can see a world in which we see a lot more individuals recognizing the benefit of the investment trust industry that we have in this country, which has got quite a nascent place, but is a very special thing. So I think we just need a bit of success and a bit of transaction activity to bring the whole industry to life, particularly with that sort of public or retail lens on it.
So a common theme that I've picked up is we've been talking our own market down. And we saw that session from Simon French where he was myth-busting a lot about the UK stock market and UK economy. And actually, it's not as bad as it seems. Are we going to see some exciting opportunities come through in the IPO pipeline is my first question. My second question is that enough to ignite the zeitgeist around investing in the UK?
You're looking at me. I'm going to.
Yeah.
I'll take the prompt. Look, I think there's many factors that need to play out, and there is a lot of work still going on to try and push for fiscal change, to stamp duty and other means in terms of top-down. What can we do to shine a light on people investing in equities and bonds and for their own account? I think from the ground up, though, I'm a firm believer, and in fact, I know that we've got a fantastic pipeline of companies that have already made the decision. They're not going to list in New York, and if they're looking at Europe, London still is the right place to be. And they've made that decision because the listing rules that changed last year, which is the result of a lot of hard work from lots of industry participants, the regulator, and so on, that's set the scene now for London to be more than competitive with New York and other markets, Amsterdam, and so on. And so it's really exciting. If we see half the number of companies, I think, that have mandated a London agenda come through, then the rest should play out. And in terms of what businesses am I talking about, I think it's really interesting. Almost on a daily basis now, you'll see an article referencing another business that's considering an IPO here in London.
And how soon will we see that? Because from my 3 years spent at Hargreaves Lansdown, we were waiting with bated breath for the next IPO, and there was a drought. There's been a drought.
So I've spent 30 years in this industry, and I've never known a period as inactive as now. But equally, I've never seen a pipeline as pregnant and full as it is today. I think you're going to start seeing some fantastic businesses, particularly mid-sized, mid-cap businesses, come to market from September, October, and they have been, mooted in the press. The real window, as has been widely, accounted for, is next year, and that's important because that's when the regulatory changes kick in earnest. But actually, I think by Christmas we all have reason to celebrate, the depth of liquidity that London can provide, and I believe the role that retail can play.
And are we talking about companies founded in the UK? Are we talking about Europe, US, global companies?
Great question. I think there's some fantastic domestic UK-grown businesses, but actually you've got companies across Australia, Canada, Europe, Asia, and even US businesses thinking, actually, I don't identify with what's happening over there. London's the next best option.
Happening in the US?
Correct.
Okay.
Yep.
The other, if I may come in, I think also more restrictions need to be lifted. I'm just going back slightly. I don't know whether people remember, but for a long time, AIM shares were excluded from ISAs, and I was one of those leading the campaign at Westminster. It was the then Labour government to actually get AIM shares eligible for ISAs, which of course they are now. But I mean, as a grandfather, I'm not allowed at the moment to open a junior ISA for my grandson or granddaughter. I can only do that and have done that through their parents. Now, this is an absurd restriction. Surely a grandparent should be allowed to open a junior ISA for one of their grandchildren if they so desire. And so I've done it via their parent because I have to with two of my grandchildren, and I put in £5,000 for each of them. And I bought, this is an example of how I tried to do it. I bought for them, in discussion with them, shares in companies that they can actually touch and identify with, like Tesco, like Sainsbury's, like Hollywood Bowl, like Bloomsbury Publishing, Harry Potter, like JD Sports. And so they can begin to understand that they own a small proportion of those particular companies. And the 8-year-old, when I was talking to him about this, and his grandpa, he said, I want to buy shares in Standard Chartered. So I sort of was somewhat taken aback by this and said, sort of looked at him and said, where did that come from? He said, yes, he said, because they sponsor Liverpool, and he's a big Liverpool supporter.
I love that. I love that.
So we bought some Standard Chartered shares. But, you can build bridges with young people and get them involved, but we do need more restrictions being lifted.
And how about you touched on AIM, so that's a great example of engaging the next generation of investors and educating and creating that culture of investing from a young age. But we know that AIM is struggling. We know that a lot of investment mandates are moving away from AIM. How are we going to reignite interest in AIM?
Well, I have to tell you that I'm a bigger investor in AIM stocks. Yes, you obviously have to differentiate between the hope and prayer to be charitable AIM stocks and those serious businesses. And I'm invested in a lot of AIM companies that satisfy the normal criteria that I would apply. And there's some excellent established businesses, some great growth businesses, and I think we need to really beat the drum more for the AIM market and point out the very successful businesses that are there.
And could you pick out some names for us?
Yes, a company like Concurrent Technologies, for example, which is an equal holding of mine in size terms to M&G. Has been a company with a great growth record. Cerillion, which is in business services for the telecom sector, has been an outstanding performer. So there are a number of them.
So let's get back to just talking about financial education, the London Stock Exchange, what's happening. Everyone talks about the Tell Sit campaign of the 1980s, and it feels like there was a dearth of anything since then.
Yeah.
Anything you can share with us, Will, that we can get excited about?
Yeah, get excited. I think the whole point I've said there in terms of it's the financial influences, that's critical. But also Tell Sid was in this, I think it was 70s, 80s, which was a fair while ago. We're talking about Tell Sid 2.0 with this kind of lead reforms, hearts and minds. What's incredible is that there's been nothing since then in this kind of way. So talking about television, social media, we need everybody engaged but taking action, and it's going to be the whole of the industry. And I think also to the point of why should you invest in an AIM listed security or a UK main or whatever listed security? It's that if you're investing in crypto, you're probably funding a grid of electricity.
Speculating in crypto.
Yes, exactly.
I really get upset when people use the
speculating,
word.
exactly.
Not investing in crypto.
Yeah, exactly.
Investing is buying stakes, in businesses, in crypto. And fair enough, if people want to put their money there, they're essentially speculating. They're not investing.
But crypto is a way of engaging the next generation.
Yeah, yes, you can explain that actually. If you invest in an AIM listed security, it's tangible, as you said, Lord Lee, but also you're investing in a company, in your economy, so you're bettering yourself as well. So it's bringing it back to why should I care about UK securities and the stock exchange when I've got crypto and Bitcoin and whatever here, there and everywhere, and it's really attractive and it's really punchy and quick and easy. Actually, it is speculative and it's not long term. If you want to invest for your future and your financial planning, you should care about your homegrown companies, etc. So I think it's influencers. I think it's talking to the right people. So it's through social media, but it's also understanding that we need to talk up our own industry and talk up our own economy and say that actually you can invest wherever you want, but ultimately if you invest here, here's what it means and what the outcome is for you, your family, and your economy essentially.
So when we talk about finfluencers, and I know quite a few of the finfluencers, but there's no household name. There's no Martin Lewis of investing. James, I'd love your thoughts on that. How are we going to create the next Martin Lewis of investing? Is that the way to go? Or do we need to look at pension funds and push them to invest more in the UK stock market?
Well, what we need in some ways is the sort of David Attenborough of investing, and Lord Lee's been sort of in those shoes squarely for quite some time.
All the fans.
But I think you just mentioned the pension funds, and I don't want to lift the lid on a hornet's nest, but there's plenty of factors at stake. But there's something very, very stark and clear which needs to shift, and that is that your UK pension fund today has an exposure to domestic UK equities of typically 2 to 4%. Which 10 years ago was 50%. And if you look at any market globally, particularly in the developed world, the average is around 30%. So any pension fund industry has at least a 30% exposure to its own marketplace. And of course, some nations are much higher than that. So the fact we are at such an extreme is quite stark and needs to change. We can't go down from here. I think what's interesting is, you're starting to see UK equities outperform other indices, and that will ebb and flow. It's not going to be a straight line. But I think to the point around AIM, and generally, there is so much value at the smaller and mid end of the market, and indeed on the AIM market. And if the pension fund trustees are suddenly being held to account because their exposure to the global index, which is 70% US, suddenly isn't performing as well as it was, I think that plays an important part in shining a light on what is performing and where value lies. So if we see the pension fund industry start to shift somewhere closer to, say, 10%, which is still a third of where the global average is, that's a big move in terms of money flows, and can do a lot, I think, for shining a light on where value is and what can drive markets in the right direction, and particularly at the smaller end.
So Simon French had an interesting chart up, and he made that point, and I think it was at 2.7% is pension funds exposure to the UK market, which is obviously less than the 5% that the UK market makes up of the global index. I'm interested, Ludley, you said earlier that you don't invest in companies that are not listed in the UK. Do we need to look at that global benchmark more, or should we be a bit more contrarian?
Well, I invest solely in the UK and always have done. Because I think there's real value here, and certainly over the years, brick by brick, I've built up my own ISA and my own non-ISA portfolios. And secondly, also because I actually like to and can relate to UK companies and enjoy the relationship that I have with them.
Although they are global players, a lot of them.
Of course, they're global players, but nevertheless, with them being based in this country, or certainly quoted in this country, one can have a relationship with them. So I like to visit. Well, in the old days, I used to visit them. Now, I can liaise and can talk and discuss with chief executives and similar, and one has lunch with them, and there is a dialogue, and I do enjoy that relationship, and also I enjoy backing UK companies. If I can just jump back to the point about personalities, I believe that it was linked into what I said about television, that if we were allowed to talk about the stock market and investment opportunities on television, or maybe now more on social media, you actually would get the personalities being developed, rather as you got with the Dragon's Den personalities, for example. But Martin Lewis, he actually is a bit again the stock market anyway, and he's mainly focused on non-investors really, who he is advising to switch from one gas company to the other utility, as it were. So he's not really the stock market man.
Yes.
But there are many personalities who would come through television if I think the opportunity was actually given. But because of this sort of whole weight of regulation, the individual television companies and producers are reluctant, because they feel they're going to get wrapped over the knuckles by this regulatory body or that regulatory body, and so in the end nothing happens. And it's I come back to what I said earlier. I don't wish to be boring, but I think it's a national tragedy and a huge opportunity. And I think if there's a finger that could be pointed at one thing that's been wrong, it is the lack of involvement from television.
So we need the regulator to play more of a role, because even if we talk about television or finfluencers, a lot of them are very cautious. You will struggle to find a finfluencer talking about AIM or small caps because it's too risky, and the risk is involved with that. And a lot of these finfluencers talk in very broad terms about investing. So I guess to wrap up, there are two themes I want us to explore. One is, let's talk about pensions and the role pensions will play and how we get the broader UK populace engaged with their pensions, because as we know, we've shifted from the DB Rolls-Royce of pensions to DC, and there's an imperative for us to become engaged with our pensions. Auto-enrollment means that anyone in formal employment is an investor. So how do we use that? And my second question is, we can talk about regulation all we like, but culturally, how do we make that shift? What do we need to do as retail investors to get the next generation engaged, to trickle down knowledge and expertise? And I'll start with you, Will, and we'll wrap up on that point.
I think the point there on kind of, the engagement and financial education, actually right now there is financial education within the school curriculum, it's there, but it sits, I think, in PHSE, which is a class that most people go to perhaps and don't pay the most attention. I certainly didn't. So I think it needs to come into the mainstream, and it's not the teachers' fault themselves if they don't know, because actually they themselves haven't been financially educated. So I think it needs to come into the whole, the whole of the curriculum. But also I think that it starts as well with legislation and policy change. So it might be the government of the day, which is currently Labour, invoking things that actually make sure it is front and center and is part of the curriculum and is part of the discussion, because without that, you're not going to get that trickle down into the next generation. But equally, the next generation is the one we talked about today, consuming content in a very different way. Actually, we need to get comfortable with it. As I said before, there's some great work, like the Bank of England's doing really cool stuff with their social media.
Who? Sorry, I didn't.
The Bank of England. Yeah.
Bank of England.
And
okay.
there's an influencer called Abigail Foster. She's going to Treasury. She's gone to the Bank of England. She's come to the exchange. She's a trained accountant. So it's those types of voices we need that might carve out those types of educators that could be the Martin Lewis of investing. And I think, again, touching on pensions, it's not just about buying UK listed securities, it's the whole piece of financial planning. So if you have a pension, you're essentially a retail investor. If you want to have a balanced portfolio, you should also buy bonds, gilts. If you want to take some speculative approach, maybe get some AIM securities. It's that wholesale kind of financial planning approach. And I think if we do all that, we'll slowly but surely start to create a culture that might be more like the US or Asia or the Nordics. But it's generational.
James?
I work with a really fantastic team of people that for the last 6 years have forged quite an interesting track record of, every company, particularly FTSE 100 and FTSE 250 business, that's gone cap in hand to raise money, has put the transaction out there to a broader audience of retail investors. It's been a very small part of the deal because of regulatory restrictions. As discussed, those are now changing. What we now need is to see some success. I think the press are poised to celebrate success, and I think that can snowball in many directions. To slightly repeat what I've already said, if we see a handful of high-profile businesses, businesses to Lord Lee's point that you can touch, if they start to raise equity or indeed bonds. So if you were to see Tesco push a bond out to its customer base, that's really exciting. And I think we're going to see that in the next year or two. And what does that mean? It means the individual starts to question, where is my pension invested? And, oh, now I have an account, as I repeat myself of earlier, what else can I invest in? So I think the ground up, opportunity is big. We just need to see, the choke sort of pulled and the engine kick-started.
So we have these IPOs coming, poised for September, October. We need the media to celebrate these. We need a success story. What about performance? Because we know, a lot of the listings went to the US. They woefully underperformed. And we know historically, we spoke about investment trusts earlier, we did have a raft of investment trusts listing back in 2016, 17, but they have underperformed. And a lot of retail investors have fallen out of love with those vehicles.
I would, this isn't hiding behind anything, I would just point attention to the fact that we are in a cycle. And sadly, there's too many people that haven't been around long enough to recognize what the upside of a cycle looks like, and they think it's darkest before it goes completely black. And I'm happy to say that's not the case. And my view, clearly, with what we're seeing in terms of transaction flow coming, and just market levels, and actually you're already seeing the kernels of performance from UK equities versus global indices and so on. So I think we're at the beginning of a really exciting phase in terms of a cyclical upturn.
I like the positivity. Lord Lee, last word to you.
Well, I just refer back to the the idea of £5,000 worth of the NatWest shares going to all the state secondary schools. I think that would have been transformational. That opportunity is now gone because obviously the government's disposed of all its NatWest shares. But what I was hoping that we could then build on, and it can still be done, is that for regional public companies, to actually give or donate a small portion of shares to their local state secondary schools. Now, obviously, this wouldn't apply to your major FTSE stocks, but if we've got a lot of smaller regional public companies all up throughout the country, many members of the Quoted Companies Alliance. Now, usually you would find, I think, that there are maybe 4 or 5 state secondary schools within the orbit of a particular public company, from which they hope to recruit employees in the future, and where many of their existing employees actually children go to school. And they could easily build bridges to those local schools by giving them a small portion of shares or similar. I mean, founding directors who've got major stakes themselves could easily do that, and begin to give youngsters, teach them the real advantages and opportunities of investing. And as I said before, learning for the first time about banks and about shares and about dividends. So it can be done. There are opportunities there, even if people actually do think a little bit more laterally about what can be done.
Okay. Thank you, all three of you. It was a great debate and discussion. I guess to sum up, we are talking about the rise of retail. There's a lot that needs to be done. The biggest barriers have been regulation and culturally, and talking down our own market. But the tide is turning, and there's a lot of industry alignment, there's a lot of regulatory change, and there's a very exciting pipeline of IPOs coming. So for the die-hard, loyal retail investors who have stuck through the cycle, I think we can finally breathe a sigh of relief that the rise of retail is coming, and there will be some really interesting opportunities. Thank you to all three speakers, and thank you for listening.
Thank you.